Hey guys, so with the stock market crashing last year and then reaching all-time highs and now back down again, I'm sure you guys are probably wondering what's going on, how long this period is going to last, and what to expect next. So that's exactly what we're going to be talking about, so stick around. Hey guys, welcome back. I'm Ben Graywell and thanks for visiting my page. If you're new to the channel, then definitely hit the like and subscribe button and check out some of my previous videos. So let's just dive right in without wasting time. First, let's take a look at one of the main reasons why stocks can potentially go lower, but why I think they won't just yet. And then we'll take a look at how long we might be in this bearish market. So first, let's take a look at valuations. And I want to show you guys a very quick clip of Warren Buffett talking about valuations because I don't think anyone says it better than him. It's only a minute long, so watch this and we'll come right back to it.
He says, what's your mindset when you see so many of these high flyers, not the GME or meme stocks, but more like the big tech growth stocks gaining 50%, 100%, 200%, etc. in a matter of a year or less? I know you eventually bought Apple in 2016 because of the quality of their businesses and their management. How do you assess if these high flyers are worthy of your investment given this crazy high valuations that muddy the waters?
Well, we don't think they're crazy.
So even though you guys only saw like 2 seconds of him talking saying he doesn't think they're crazy, that pretty much sums it all up. I will link the interview in the comments down below, but now let me give you my input on why I don't think they're crazy either. So although there's low interest rates and then with the Fed saying they're going to keep interest rates low until 2023, the current valuations are still very high. But this doesn't mean that everything is actually overvalued. If you guys watched my last videos, you would know of some stocks that are really undervalued, but in general the average company is valued higher than it was previously due to inflation. And this isn't necessarily a bad thing. So right now, the S&P 500 Shiller's price to earnings ratio topped 37, which is well over double the historical annual average of about, 16.82. And if you guys don't know, the Shiller's price to earnings ratio is based on the average earnings adjusted for inflation from the previous 10 years, whereas when we just say the regular price to earnings ratios, those are for the last 12 months. And the reason why this is important is because that you can see from this chart that this ratio has only topped 30 in the past 150 years, just only a few times. And in all of the previous instances, the S&P 500 eventually retraced by a minimum of 20%. But the reason why the average price to earnings ratio is at one of the highest points in history is because it's directly related to interest rates and bond rates. So to give you guys some background, investors have two general places to put their money, either stocks or bonds. And if you guys don't know what bonds are, then definitely check out my previous video. It's a very quick summary of what they are. It's like 3 minutes long, but let's just assume you know what they are. So for example, let's say you have $1,000 face value, 5% coupon bond. Don't worry, I'll explain it all. So this means that you are earning 5% interest income while holding that bond. So now if interest rates go down, the cost of borrowing decreases. So this means that any new person that will be lending money will now be getting a lower rate. So the next person will have $1,000 face value, maybe a 3% coupon bond. So this person only earns $30 while the other earns $50. So just like stocks, bonds also have their values changing over time. And now, since rates have fallen, that person that was earning 5% interest income is in a better position, so the value of his bond would increase because it's more attractive and the holder would get a better return than average. So to sum it up, there's two things. If interest rates are low, that means bond values will be high, so people will switch over to stocks because when rates fall, this benefits personal and corporate borrowing, just like we're seeing in the housing market right now, as well with people borrowing, people being able to finally afford new homes with low rates and massive amounts of money being injected into the market. That's causing inflation. But this also leads to greater profits in short term and long term. Also increases future earnings as well as leads to higher stock prices because companies are making more money. So bond buyers, they receive a lower interest rate and less return on their investments, so it forces them to consider buying stocks to get a better return. And that's why, since interest rates are low, stock prices are very high and companies are valued highly right now. And if interest rates go up, the exact opposite of what I just said would happen. So bond prices will fall, meaning investors can make a larger gain by putting more money into bonds, so they take money out of stocks, and future earnings for companies will also decrease. So much government stimulus was given out this year, and to be clear, it's about 18% of supply that was created. Or in simpler terms, imagine you have a $5 bill in your wallet. 1 out of $5 was actually created in 2020. That is a lot of money that was created and put into the market. So with this extra cash, people are looking to make good returns. And if we take a look at bond yields right now, it's at actually one of the lowest points in history. So this only makes sense that people will be moving money out of bonds and into stocks. So if you look at 2020 right here, it hit a low of almost 0.64, and now it's kind of hovering around the 1.72, which in the last 50 years is one of the lowest points in history. And according to the International Capital Market Association, the overall size of this global bond market in terms of USD is approximately $128 trillion. So if there's $128 trillion in bonds which aren't earning a great return, well, that's money that has to switch over someplace where the returns are attractive enough, which would be stocks. So now let's take a look at how long this period can last and what I think will happen next. So double-digit declines occur every 1.87 years on average, and since we just had a wild COVID crash, that was roughly 1.1 years ago. And this doesn't mean the market always follows these averages. This is just letting us know that crashes and corrections are a completely normal part of investing in the market, and this is just one of the risks that you have to take and go through if you want to join and grow your wealth to a new level. So now that we know roughly how often it happens, let's take a look at roughly how long these crashes or corrections actually last. And this is one of the most important things to understand, because we'll never know exactly when it'll be over or how much it'll drop by, but history suggests that a majority of these corrections don't last very long. And data shows 24 of the 38 double-digit declines in the S&P 500 have found their bottom in 104 or fewer calendar days, which is about 3.5 months or less. And of those 38, another 7 hit their bottom in about 157 to 288 calendar days, which is about 5 to 10 months. And the remaining 7 of those 38, their declines actually lasted a little bit longer than a year. So I hope this video shows you guys that you don't want to quit the stock market. I'm still buying. I would definitely recommend finding those few stocks that you guys really like that are undervalued, or just get into some bank stocks that are very safe, and just sit back and relax, because when you zoom out and look at the big picture, 1 year or just 1 or 2 years in the market are just tiny little blimps in the overall general market. If you look at the history of 30, 40, 50 years, it's always growing. So definitely sit tight, and that's all I have for you guys today. If you guys liked the video, please go and hit the like and subscribe button down below, and I'll see you guys next time.